Hi, my name is Irina, and I'm a practicing accountant in Chicago, Illinois. Many of us get into debates in the face of today's economy, and no matter how nuts these debates get, somehow these discussions have become a form of science. Maybe you've wondered why all the tax cuts are targeted at wealthy investors. Are they really necessary, especially given the amount of borrowed money, only to be reminded that these tax cuts will stimulate both the investment and the growth in our economy? Don't you get it? The story goes, we can't afford not to cut taxes. Or does that only hold true for certain kind of investors? I engage in useful, open-ended, rant-free dialogue with everyday investors and people about their accounting questions. I've been having entirely too much fun talking about progressive tax, accounting, and the economy. Think of this podcast as a chance to hang out with someone who likes to tackle accounting questions and promises to answer them in an engaging and simple way. So let's get to it. Come on, what do you say? I'm just getting started. Welcome to episode 4 of the Tax Lady podcast. In this episode, we're going to explore how real estate leverage works and explain how investors use leverage to boost potential returns to help answer the question if being over-leveraged is good or bad. Real estate investors often use leverage to help increase the performance of their returns. While this works well when property values are appreciating and operations are running smoothly, it can backfire when things aren't going as well. Leverage is a tool that real estate investors use to increase potential returns from rental property. While using leverage may help improve returns, being over-leveraged can be too much of a good thing. Let's first look at what is real estate leverage. Real estate leverage is a technique that investors use to acquire a property using a combination of debt and equity. When a property is over-leveraged, the loan-to-value or the LTV ratio is high because a borrower makes the smallest down payment possible or sometimes no down payment at all. For example, assume an investor manages to buy a rental property with no down payment and finances the entire purchase price. The investor's leverage would be 100%, a situation that could be described as being over-leveraged. On the other hand, an investor who pays all cash for a property could be described as under-leveraged, or more appropriately, unleveraged, because the asset is being purchased without using any debt. One of the best things about investing in real estate is that leverage makes it possible to generate potential profits through the rental income and property appreciation of a rental property by using other people's money. Although it may seem impossible, investors who use high amounts of leverage may be able to increase returns by using very little money of their own. Let's first talk about over-leverage. Let's assume an investor purchases a $100,000 rental property for a down payment of 5% or $5,000 and finances the rest. If the gross annual rental income is, let's say, $12,000, operating expenses are $4,800, and the annual mortgage payment or principal and interest is $5,450, and the annual pre-tax cash flow is $1,750. By dividing the pre-tax cash flow of $1,750 by the total cash invested, $5,000, the cash-on-cash return would be 35%. $1,750 divided by $5,000 is 35%. While an annual return of 35% may be very impressive on paper, there is a high level of risk involved when an investor is over-leveraged. By dividing the pre-tax cash flow by 12 months, we can see that the investor generates a positive cash flow of only $145.83 per month. The small amount of cash doesn't leave a lot of room for error if something goes wrong. For example, the total expenses for operating and financing the rental property in this example are $10,250 per year, or $854.17 per month. If the current tenant leaves and it takes longer than expected to find another qualified tenant, or if costly repair needs to be made, cash flow on an over-leveraged property could turn negative in a blink of an eye. There is something that is considered conservative leverage. Most lenders making loans on a rental property require a minimum down payment of at least 20% of the purchase price, and sometimes more depending on factors such as the borrower's credit score and type of rental property being financed. By making a larger down payment of 25% or $25,000 on the same $100,000 rental property, an investor earns a lower cash-on-cash return. However, there is also more monthly cash flow because the mortgage payment is reduced. If the operating expenses are, say, $4,800 per year and the annual mortgage payment or principal and interest is reduced to $4,300, the annual pre-tax cash flow would be $2,900 and the cash-on-cash return would be 11.6% or $2,900 divided by $25,000 total cash invested. While the cash-on-cash return isn't nearly as great as when an investor is over-leveraged, there's more margin for error in case something goes wrong. There is also something called no leverage. Some real estate investors out there don't like the idea of paying interest, even though mortgage interest is a tax-deductible expense of owning a rental property. Instead, they purchase a property with 100% cash and no leverage. Although the cash-on-cash return is much lower, investors who are risk-averse may sleep better at night knowing that they don't owe the bank anything. Using the same $100,000 rental property example, with an annual pre-tax cash flow of $7,200, which is calculated by subtracting the annual operating expenses of $4,800 from the annual gross rental income of $12,000. By dividing the annual pre-tax cash flow by the $100,000 used to pay for the rental property in cash, the cash-on-cash return would be 7.2%, or $7,200 of the annual pre-tax cash flow divided by the $100,000 total cash invested, 7.2%. In this example, there's quite a bit of cash flow each month if the tenant unexpectedly leaves or a major repair needs to be done. In fact, some real estate investors try to reduce the leverage or outstanding debt on one property as quickly as possible. Then they set aside the cash flow until enough money has been saved to make the down payment on another rental property. Let's discuss what are some of the options for a real estate investor to do financing through other people's money. We hear that all the time in real estate. So here are some options. You can finance through traditional banks, credit unions, mortgage brokers, private money and hard money lenders, or partnering with other real estate investors by forming a joint venture or a limited liability company. Interest rates, loan fees, and terms and conditions vary from lender to lender. Generally speaking, a lender will expect an investor to have a credit score of as high as 620 and a debt-to-income ratio of no more than 36%, and to hold enough cash in reserve to make 6 months of mortgage payments. So let's recap. Leverage in real estate can be a good tool to increase potential returns. However, being over-leveraged can put an investor in a very bad position if real estate market conditions change or the property doesn't cash flow as expected. During the global financial crisis of 2007 to 2009, millions of people defaulted on their loans and lost them to foreclosure. Over that 2-year period, the median sale price of houses sold in the U.S. dropped by 20%, according to the Federal Reserve. An over-leveraged investor could easily have been turned upside down with the mortgage debt on the property greater than the property market value. On the other hand, an investor using conservative leverage may still have had some equity in the property, making it easier to sit tight and wait for the housing prices to recover. Of course, not using any leverage may also mean leaving money on the table, especially when interest rates are low. In the example I mentioned earlier, an investor using a conservative amount of leverage generated a cash-on-cash return of 11.6% by making a down payment of 25%, While the return isn't nearly as great as being over-leveraged, using less leverage can help create a more balanced blend of risk and potential reward. So just for some final thoughts, investors who are willing to accept high levels of risk may choose to over-leverage a property purchase by making a small down payment as possible to increase potential returns. But while the returns may be impressive on paper, there's much less margin for error in case something goes wrong. Leverage in real estate can be a powerful tool to increase potential returns, but investors may wish to think about the risks involved and not just the rewards. An investor who is over-leveraged may quickly have cash flow problems if the real estate market changes, while investors who use leverage wisely may be better prepared for the unexpected. The views, thoughts, and opinions expressed in the Tax Lady podcast are the speaker's own. The material and information presented here is for general purposes only.